Hi, everyone. It's Alyssa Corum with Investors Business Daily, and welcome to Investing Strategies. Now, this year has been a very different year for the stock market than 2020 in terms of the groups that are outperforming. So we checked in with SoFi's head of investment strategy to talk about the trading landscape and factors that are playing into how the rest of the year is shaping up. Plus, earnings reports can be a make or break moment for a stock. IBD Market Research Director Justin Nielsen explains how to determine whether you should hold or sell your shares before the company releases its quarterly results. And non-fungible tokens are generating a lot of buzz and sky-high valuations. So Loup Ventures is here to break down the NFT craze and how investors can capture this new digital asset trend in the stock market. Investing Strategies starts right now. This year's trading environment has been a little trickier for investors looking to pick winning stocks with a big rotation out of technology in effect. So what factors are playing into how the rest of the year is shaping up? Here now to discuss that and more is Liz Young. She is head of investment strategy at SoFi. Thanks for joining me today, Liz.
I'm delighted to be here.
So 2021 has been a very different year for the stock market than 2020 in terms of the groups that are working and seeing out performance. Last year was all about growth and tech, and now it's all about these economic recovery plays. So how much longer do you think this rotation is going to continue to play out?
Well, let's take a step back first. And 2021 should be different than 2020 in the way that it plays out in the stock market and the way that it plays out in the economy. What we were looking at in 2020 was really just a dire situation through most of the year. And by the end of the year, we had a little bit more optimism, obviously got into the vaccine news, and we started to look ahead and say, okay, the future might be better than the past. And then we got into 2021 and the data started to get better. So this is really the year where the rubber hits the road. And I think that's what the market is trying to work through. We're naturally going to go through a bit of a transition. And anytime you have a transition, there's likely to be rotations in leadership in the market, which is what we're seeing right now. And I think the rotation that's happening, number one, isn't bad for all the sectors. It isn't necessarily even bad for tech. Tech is still eking out gains over this period. It's just that the spread between what the big technology stocks had in 2020 versus the rest of the market is not going to be the same as what they see in 2021. But that doesn't mean that there isn't still upward momentum.
And yeah, speaking of that momentum, we're seeing more of that for the S&P, for the Dow, and definitely not for the NASDAQ. There's this bifurcated market going on. Do you think that that will eventually resolve itself? What are some of the things that you're looking at that might help indicate how that plays out?
Right. Well, first and foremost, momentum is a powerful force, and I would not ever suggest that somebody try to fight it. But one of the tricky things about momentum is that it can change course very quickly. It can change course on a dime, and it's really difficult, if not impossible, to call that inflection point. So what you really want to look at here is what are the parts of the market that are likely to do well as we recover and as we hand the baton from policymakers, so from fiscal policy, from monetary policy, back over to company fundamentals. And when I say company fundamentals, what I mean is earnings quality, right? Are earnings beating estimates? Are earnings healthy? Are companies healthy? Are their balance sheets healthy? Are their income statements healthy as we move throughout the rest of the year? And we need to hand that baton off. So as we look at what investors should think about and the ways that momentum plays into that market, I think as we move through the rest of the year, you're going to see this shift into more quality names. And the momentum in the broad indices can continue. But as I stated earlier, I mean, the NASDAQ is really a tech-heavy index. It holds a lot of those big tech names. So because there's not likely to be a huge spread between those big tech names and the rest of the market, you're going to see the NASDAQ struggle. Also, as you look at the 10-year Treasury and just interest rates in general, the NASDAQ is really sensitive to those interest rates. And as the 10-year Treasury rate goes up, we're on a little bit of a pause right now, but as it goes up through the rest of the year, which I would expect it to do, it's a little bit of a headwind for those big tech stocks as well.
And you mentioned earnings, and it seems like even with largely strong earnings reports, investors shouldn't necessarily bank on that to fuel the next leg higher for the market, or even the individual names that they are playing, because the reaction to reports may not be in line with what seems on the face of it as seemingly strong numbers.
Right. Earnings season is always a mixed bag, and it can show really strong results, which it did this quarter. But the mixed bag then is, what's the market reaction to that? And what I think investors really need to remember is that the market is looking at what things are going to be 6 to 12 months down the road. And when you get earnings reports that are already widely expected to be positive, the market doesn't really get surprised by that. So the market will change directions when it gets surprised. I do think, however, that we're underestimating earnings strength throughout the rest of the year. And there's a lot of talk lately about valuations and whether or not things like the S&P 500 are overvalued or overbought. And it's true that about 95% of the index is trading above its 200-day moving average, which you could look at as an overbought signal. But when you look at earnings and when you look at the multiple on the S&P, and specifically the PE ratio, if you just take the multiple, let's call it 22.5 times, and extrapolate that out with an earnings expectation of about 180 to 182 per share this year, all it would take is for earnings to beat up to like 186, 187 per share. And that means the S&P is trading at a reasonable level right now. So if we beat on earnings, which I think we're going to do for the rest of the year, this is a pretty reasonable place for the market to be trading.
All right. And the market is trading clearly at very much higher levels than it was last year, which was a very historic year in many ways, attracted a lot of new investors to the market. And for those who may be basing their trading rules or even their ideas off of what was working last year, they may have been in for a rude awakening this year. So what are some of the things that newer investors you think should be thinking about in a market like we're in right now, which again is very different than what we saw last year?
Yeah, well, there's actually a name for that. It's called recency bias. And it's when you look at what's most recently happened and expect it to continue on into the future. We talked about this a little bit earlier. 2021 is a very different year than 2020. So number one, the market is going to react differently. Different leadership is going to take shape. So it's not just that different stocks are going to take shape, different stocks are going to lead this out, but it's also that when you look at just the magnitude of what happened in 2020, I mean, we had this huge fall off and it was the fastest decline in history. And then we had this enormous rebound off the bottom. The magnitude of highs and lows that happened in 2020, and even the day-to-day swings from high to low in 2020 are just not regular occurrences. So 2020 was really the exception, not the norm. And I think investors looking out ahead, even if they're new investors and haven't really had a lot of experience living through a full market cycle yet as an active investor, looking out ahead, the average return on the S&P annually is about 7%. And that's a good expectation. Now, we're not going to have every year kick out a 7% return, but on average, over, let's call it a 5 to 10 year period, you get about a 7% return annually. So making sure that you're setting your expectations properly is first and foremost something that I want investors to think about, but also thinking about having a diversified portfolio, because what led in 2020 was a very narrow basket of stocks, a narrow basket of names. And what you want to see in the market is a more broadened out strength. So you want to see strength from a lot of different sectors. You want to see it from different size categories. You want to see it from different names. And if you have a diversified portfolio, you give yourself a better chance to participate in all those different corners of strength.
Right. And one way that investors can diversify while still being a little bit more tactical is looking at some ETFs. There's pretty much an ETF for any theme out there. And of course, tracking all sorts of different indexes and using leverage funds, which of course are not for the faint of heart. But that's another way that investors can look to capitalize on some of these themes or different sectors that are working without having that individual stock risk and having to pick the winner of the group.
That's right. Yeah, that's exactly right. So ETFs are a really easy way to get low cost exposure to a basket of securities. and you don't have to take that single security risk or expose yourself to headline risk on a specific company or people risk on a specific company. And ETFs also run the gamut. So you can have ETFs that are tracking a very broad index and it's a very diversified portfolio of securities, or you can have ETFs that are targeted for a specific sector, a specific industry group, or what's actually been happening a lot lately is ETFs that are going after a specific theme. We actually have an ETF at SoFi that follows the gig economy. So if you look at ETFs that are following a specific theme or something that's a little bit more narrow in the market, what you can do is build a portfolio that at the core has a diversified profile, right? And you have broad exposure to all of the things that are the stock market and the bond market and everything that would qualify as a core of the portfolio. And then along the periphery, you can add to things or add pieces of it that express your views in a more specific way. So if you feel very strongly about social investing, for example, or if you feel very strongly about technology investing, or you feel very strongly about a certain part of the materials sector, you can express that through an ETF and you can move it around over shorter term periods and make it a little bit more of a tactical bet.
Yeah. So speaking of that tactical element, what's your advice for individual investors out there looking to get tactical over the next 3 to 6 months? What are some of the things that they should be thinking about?
Sure. So over the next 3 to 6 months, it's really the recovery story. It's the reopening story. And I want to also outline that there's a difference between a rebound and a recovery. What we've seen so far is largely a rebound. Once we get back to prior levels of GDP, which should happen about the third quarter of this year, once we get back to prior levels of GDP, then we create new organic growth and we recover and we make up for the lost time from 2020. So when we look at what the reopening story is, I think it's going to be a lot of the stuff that we've missed and the things that we were restricted from doing. So it's things like travel, it's things like leisure, restaurants, dining, everything that we can do out in the open. The weather is getting nicer. We can go do things outside. And I think people need to really make sure that they're exposed to that, because consumers also have a ton of money saved up because they haven't been able to spend it. And there's been a lot of stimulus that came into the system that hasn't been spent yet. So when we talk about that pent-up demand and that pent-up spending, when that starts to get unleashed through summer and maybe even fall of this year, you have to think about what are the things that you're going to spend your money on? What are the things that your neighbors are going to spend their money on? And those are the sectors that should do well.
Yeah, I think there's definitely something to be said for looking at the world around you and seeing what these trends are that are taking place. I mean, that could even be likened to the development of new technologies, and that is often correlated with stocks that take off or products out there. What are some of these ubiquitous things that are happening? So we'll have to see how the recovery trade plays out. But Liz, thank you so much for your insights today.
Thank you.
And coming up next, IBD Market Research Director Justin Nielsen is sharing tips for how to handle stocks that are heading into their quarterly earnings reports. That's after the break.
IBD Digital gives you access to our premium content.
The best of Investors Business Daily.
A team with decades of experience serving up actionable investing content, a sophisticated tool set to facilitate your own deep dives, and educational resources that will give you an edge in the stock market. We have over 100 years of stock market data, all focused on one thing: what makes a winning stock.
We're taking the guesswork out of investing. Subscribe now to build a better portfolio and make more money in the stock market.
A quarterly earnings report can be a make or break moment for a stock. And while the report itself tells a crucial story about the company, it's the investor reaction to those results that's even more critical. Joining me now to break down strategies that help put the odds of success in your favor during earnings season is IBD Market Research Director Justin Nielsen. Thanks for joining me, Justin.
Absolutely, Ali, a pleasure.
All right, so when earnings season rolls around, investors are faced with a key question. If they own a stock, do they hold it into that report? And one big part of that equation is, what does your profit cushion look like?
Yeah, absolutely. I mean, because the fact is, if you're going to be holding on to a stock for a big gain, you're going to have to sit through some earnings reports. And a lot of times with these really dynamic companies, it's those earnings reports that keep investors engaged and it gives you that feedback that you're in the right company because those earnings reports show the growth. You hear the company report and how well things are going and at how the trend is continuing to improve. All of those things kind of give you a little bit more conviction in a stock. And so a lot of times you may be holding through these earnings reports, but if you don't have a lot of cushion, because there can be extra volatility around these earnings reports, you don't want to necessarily be involved with a stock where you're taking on undue risk ahead of that earnings report because you don't have a cushion, and your portfolio could take a big hit if you're not aware of it or if you're not managing your risk appropriately.
So let's get a little bit more specific about the numbers that we're talking about. Just a kind of a general rule. What sort of profit cushion percentage wise would be ideal as a rule of thumb to be able to stick to?
Well, part of this is going to depend on the volatility in the stock that you own. There are certain companies that, look, earnings come and go, and it doesn't make that much of a difference. There aren't that big of moves, but there's other companies where it can make a big difference. Or there's some companies where the volatility in just its everyday action is enough to where you have to manage your risk. So it really depends on the company. But as a general rule of thumb, we'll use like a 5%, 10% profit cushion going into earnings. That kind of makes me feel a little bit more comfortable, because if we do get an earnings report where things don't go as planned and it comes down quite a bit, having that cushion means that I've got to lose all of that first, and then I'm going to start losing capital. So you want to have a sense of not only how much cushion do you have, but what kind of move is expected in the stock. Because if you're starting to lose not only your profit cushion, but then your capital, that's a situation where you want to be very careful and you want to manage your risk appropriately.
Yeah, Justin, as you were saying, knowing the personality of the stock is very important. So you can look at how the reaction was to the past several quarters of the report to see that personality a little bit in action when it comes to these earnings moves. But to get a little bit more specific about the expected move for the upcoming report, what should investors do?
Well, you don't have to be an options trader to use options to just give you a sense of what is expected in a stock. And one of the ways you can do that a lot of us will use, is we'll use the straddle price of a particular option. And what you do there is you're using an at the money straddle. And so you just take the call option of an at the money call and the premium of a put option, an at the money put. You add those together, and that gives you a sense of what is expected by that expiration date. And so by using that information, and again, that's going to give you a price expectation move. And keep in mind that can be plus or minus. So sure, it might go up by that much, but it might go down by that much. And so I'm usually looking at my risk factor. So if I don't have enough cushion to weather the storm of that potential move down, then I'm going to be a little bit hesitant to get involved or stay involved with a particular company before that earnings report. Now, if I have a lot of cushion, then I'm going to feel a little bit better if I'm within the expected range of that move.
Yeah, because if that expected move to the downside in that worst case scenario would put you at a 7 to 8% loss on your position, which is a very key sell rule for IBD CAN/SLIM traders, then it's probably not a good idea to be holding a full position heading into the report, unless it's a smaller position. Or what are some of the other things that would help you make that determination if it's on the bubble potentially for that worst case scenario?
Well, you bring up a very good point. Position sizing can make a big difference in your risk mitigation. So if you have a smaller position size, yes, the fact is, if it goes up a lot, you're not going to be participating as much. But you're also, if it goes down a lot, you're going to be reducing that risk, because you don't want to take big hits to your portfolio or to any individual trade, because it just takes so much, the math starts working against you. The bigger hit you take on that stock, the more makeup ground you have to do. And you can dig yourself into a hole very easily if you let a loss get away from you. And sometimes that's not anything that you could have seen coming. There's some of these reports, it comes out and there's a big change in the way that it's being valued, either to the upside or the downside. And so it's that downside risk, though, that we have to be very careful of, because if you get a stock that goes down 10, 20% and you didn't have any cushion, well, clawing your way back from that is going to be tough.
And calculating that expected move is one thing, hypothetically, but let's talk about the reality. How often are these expected moves in range with what actually happens?
Well, and again, this is where I think you had a great idea. One of the things you can do is look at historically, what kind of price moves has the stock had? Look at the last year or so of earnings reports. What kind of move has it had? You could look at the historical options market and see what was the expected move? How often was it kind of coming into that range or falling outside of that expected move range? And that'll at least give you an idea of what you're dealing with.
One final thing on taking profits heading into the report. So even if you do have a cushion, sometimes you may just want to take some profits into strength ahead of the report. What do you think about that?
Yeah, and here again, a lot of times will depend on how much cushion do you have, how much risk do you have. Let's say this is a stock that has appreciated a lot. It's become a larger position in your portfolio as a result. Well, you might want to just take some off the table because of that, by itself, just to kind of put it more in line with a normal size position instead of an outsized position. Now, if you still believe in the prospects and you're, going for a home run on the stock, then maybe you allow it to kind of continue that momentum. And as long as you have a big cushion, then yeah, you're going to take some off the top if it doesn't go well, but you're still, again, managing your risk. It's very different when you're playing with house money instead of the risk of capital, your hard-earned capital. That's where we shy away from that a little bit, because again, we don't want to get to a point where we're potentially losing 10%, 15% or more from our purchase price on a stock, because that's, again, one of those things that can be very hard to recover from. But if it's one of these stocks where we've got a lot of cushion on it, it's well above its 50-day moving average line, well, we're going to have some expectations that a normal pullback to the 50-day, and that might even happen around earnings. There might be a little bit of jostling there. But here again, it's really going to depend on your own portfolio management style, how comfortable you are with larger positions. And as we always say, it doesn't have to be an all or nothing proposition. You can sell a little bit ahead of earnings. Sometimes we'll make sure we only have a half position, or in some cases, we'll even go down to a quarter position so that we still are retaining some of the low average cost shares, but we just aren't taking that big of a risk to our portfolio. And sometimes the market is going to be a factor in there as well. How strong are your convictions with the market itself?
Exactly. Yeah. Justin, thank you so much for that comprehensive breakdown. We really appreciate it. It's extremely helpful for investors as they make their earnings season battle plans. So thanks again.
You got it.
And coming up next, NFTs, or non-fungible tokens, are getting a lot of attention right now. And Loup Ventures is here to discuss everything investors need to know about these new assets. That's right after the break.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
NFTs, or non-fungible tokens, are getting a lot of buzz right now. But are these new assets just a flash in the pan, or are they here to stay? Here now with key insights is Doug Clinton. He's managing partner at Loup Ventures. Thanks so much for joining us today, Doug.
Thanks, Alyssa.
All right, so these NFTs, give us the rundown for the uninitiated. What exactly is the allure of this new class of assets, essentially?
It's a one-of-one digital asset. I think that's really what's important. If you think about an NFT versus Bitcoin, which is probably something almost everyone is familiar with, one Bitcoin, if you and I each had a Bitcoin, they're the same thing. We could trade it back and forth, and there's really no benefit to owning any individual Bitcoin. An NFT, on the other hand, is unique. Every single one is different. One of the most popular NFTs is called CryptoPunks, which is what's called generative art. There's 10,000 of them. And every single one of these 10,000 CryptoPunks have different sort of qualities. They look different. They're little pieces of art. And so each one in and of itself is unique, and it means that they all have unique values that people are willing to pay for them.
It's very interesting. And then there's also a component of this outside of the art world and in the sports arena. So what exactly is going on there?
That's right. An NFT can be any digital asset. It could be art, it could be a GIF, it could be a clip, a highlight from a game. To your point, in the sports arena, Top Shot is something that's very popular right now. It's run by a startup, and they are essentially, think of them as, short, maybe 5-second video clips of LeBron James with a dunk in a recent game. And like we talked about with the NFTs earlier, they're limited editions, almost like trading cards from back in the day. And people are willing to spend hundreds of thousands of dollars for some of these unique and verified gifts on the Top Shot platform.
Yeah, the modern trading card. And so people are making serious dough off of these NFTs right now. But do you think that's sustainable? Is this just kind of the next tulip bulb crisis, or is this a sustainable new market?
I don't think it's the tulip bulb market, but I would say, we are cautious on the space. We love the theme, and I think that NFTs are going to have a big part of the future. But if you just think about technology over the past several decades, we often have these really acute booms before the technology sort of matures and is ready for prime time. I think about the internet in the 2000s. I think of even Bitcoin back in 2017, where we had this huge surge of interest, a lot of retail interest, and obviously we came down 80% from the peak. I don't know that we'll have that happen with NFTs, but I do think just the heat around the segment right now sort of warrants caution. And if I think about it from a much longer term perspective, if we do get a pullback in NFTs, I would be very interested in looking at some of what we call the blue chip NFTs, things like the CryptoPunks, potentially things like the Top Shot highlights that we talked about. Those are the ones I think that will have value over the long term.
And from a more traditional investor angle, what should individual investors be thinking about in terms of getting access to this theme in the public market? I know there's at least one SPAC out there that's involved in this. Are we going to see more of this theme coming to the public market?
I think so. I think every company that plays in digital content has to be thinking about NFTs right now. I think one of the really unique characteristics of NFTs is rights management. So 10 years ago, DRM, digital rights management, was a very hot topic, how you control the ownership of a digital asset. And this NFT structure is actually a perfect tool for that. And so the idea is, let's say a song file. Maybe I own that song file and I want to rent it out to people on the internet. I could earn a royalty from that through the blockchain, verified through my ownership. And the artist could also own a piece of the royalty after he or she sold me that song. And so I think that you're going to see more and more public companies that have exposure to digital assets think about using the NFT structure to distribute the assets and also to monetize them over the long term.
So on that note, what companies in particular do you think are ripe for really leaning into this?
You mentioned a SPAC. I think you're referring maybe to Topps, which we talked about trading cards earlier. I think that's a really great example of a company that's sort of evolving into this new space, an old physical collectible company, now thinking about obviously NFTs in a digital world. I think you can look at a company like Sotheby's. They sold and are working on selling NFTs, Christie's as well, the traditional auction houses working in the art world. I think those are both companies that have a lot of exposure. If you think about traditional collectibles now moving to the digital world, I think that's a great place to look from a public perspective.
All right. Well, we'll have to keep an eye on this theme with that cautious optimism, I guess. Thanks so much for your insights today, Doug.
Thank you.
All right. And thank you all for watching this episode of Investing Strategies. For Investors Business Daily, I'm Alyssa Corum. Hi there. Thanks so much for watching Investing Strategies on our YouTube channel. If you want more executive interviews and analysis of key trends to watch, make sure you hit the subscribe button so you can stay up to date.